I'm Ashlyn Lackey. I sit on the startup commercialization team at Citi, and we are so excited to be talking to you guys about the future of neobanks today. I know I cannot do your intros the same justice you can, so Chris, can you kick us off?
Sure. Chris Rigoni, I'm Managing Director for Banking as a Service for Webster Bank.
Matthew Lee, CTO for Banking Financial Services for Cognizant.
John Waupsh, co-founder and CEO of Nerve, which is a neobank for creators.
Thank you guys for being here with us. I'm very excited for this conversation, but before we really jump in, I want to level set. How are we defining neobanks? What is a neobank? What is important for everybody in this room to know?
You know, let the neobank define the neobank.
In the world, I always see neobanks as technology companies that are partnered with traditional financial institutions, and that's the way I define it. How about you guys?
Define it as an all digital capable bank, with or without partnership with traditional banks. They provide a various range of financial services, product and services.
So if that's the case, then what happens, is a bank then also a neobank? When a bank has a digital first strategy, doesn't it just
No,
become...
we separate between a neobank and digital bank. We coined the term neobank as an organization that has zero attachment or no attachment to the traditional banks.
Okay.
Digital banks, sometimes they're offshoot of existing banks.
Yeah, I would agree with that. I think, detached from a traditional bank, because there are some cases where what I would consider a neobank has gone and got a charter. So I think those would fall into that category too.
So jumping forward a little bit from what we prior in our discussion, what happens when a neobank partners with an existing bank? Are they still a neobank?
I think so. I think the banking as a service model for a neobank is something that's going to be inescapable to an extent, right? So you're going to have a chartered institution to support, debit, hold deposits, things like that, and any lending or credit facilities and different things that require a charter. So I think it still qualifies as a neobank. It's just a digital extension and not something that's owned by the bank. The bank's more of a vendor in that sense.
Makes sense. So in terms of neobanks, what makes a successful neobank? And as we look at some of the neobanks that exist today, what has been driving their success?
I think what drives neobank success is the suckiness of traditional banking.
I would agree with that.
There was for so long, it's lack of competition had kind of drove complacency in the world of banking, and over the last couple of decades, you started to see more and more competition. Certainly as branch banking and all of that started to proliferate. But then what fundamentally has happened, I think, is just the experience at the traditional bank level hasn't caught up to the expectations of where consumers and their associated businesses are today in the world of everything else we touch and experience.
Yeah. I think, to me, there has to be a differentiator. And I think I think it's just as much a question of what makes them not successful as it is of what makes them successful. So you've seen like N26 and others that have entered the US market and then pulled back and focused on the European market. I think the differentiator there is that you have to have an experience of some sort of feature or service that other either banks and or neobanks that are in the market aren't providing. So like a Monzo, for example, everybody talks about the experience of Monzo. That experience is just best in class, and then so like Revolut, for example, they've positioned themselves as one of the foreign exchange leaders, right? So their foreign exchange, prices and everything are some of the best in the industry. So they have a differentiator that makes them successful in the market. when you have other neobanks that come up that replicate, the bucket savings
Right.
and, all of these things that have been in the market for a while, you can only have so many of those, right? Because it's not like a traditional bank where you have like regions and sections and areas of the United States that they're serving. This is a digital platform that anybody can access. And so you're competing with literally everyone in the United States. And so it's a different way to approach it. You have to have more concrete differentiators.
Yeah, and also I think I agree with you, but at the same time, I think that differentiating product and experience is very important, but also the niche market. Who are you going after? Who's your target? I think well-defined audience as well as very product and services around that niche market, I think makes the neobanks very successful. You have Gen C, Gen Zs, high net worth, various different segmentations. And what I've seen is when neobanks tries to expand too much too quickly, I think that's when they lose their value of the organization. So when they're focused, I think they do really well in wherever they are, Europe, Americas, as well as Asia.
Yeah.
It's definitely a return to, community banking in the U.S. was very much, it was originally called community banking for a reason, but the hills, rivers, and streams that kind of made up that little geography were very defined by market segment. This is an ag sort of community or whatever the case may be, 100 years ago, 150 years ago now. And so as a result, those banks knew exactly what types of services and catered the way they built their organizations, and their risk and everything else was catered around that very specific defined community. And then you saw it when credit unions hit here in the United States, and they grew out of the out of the actual company, right? So whether it was a Ford credit union, we knew exactly what types of products and services, very specifically initially savings, that these lending, borrowing, that these individuals would need, and how to talk to them, and how to relate to them, and how to market to them, and all that was very organic, and it was very natural way and natural conversation that the customer could enjoy. And then the push for growth and everything else, to your point, kind of turned banks into this, hey, do you have a pulse? Have we got a money thing for you? And it's like, well, the generality became, a master of none sort of thing. So the specialization, I think, that you're seeing now in neobanks, is very reminiscent of the original models of community banking here in the U.S.
So then some might be arguing that neobank is really just a community bank 2.0, focused on a very specific subset of people that maybe instead of being connected by geography the same way a PTA or a local company would bring people together, you now have these shared interests that potentially the internet amplifies.
Absolutely. It wasn't, when you think about, there's like Virgo right now I'm not sure if they've launched yet, but they will be soon enough. They're specializing in the community that like builds houses, and all of the people that are affiliated with that process, everything from interior designers to and so that's a very connected community that has very specific needs, and from a risk perspective, you can get to understand now the way this organization of people works and really become specialists at it. And that's what we're seeing kind of, with this next generation of neobanks, whether it's Community Bank 2.0 or it's Neobank 3.0, however we kind of went from neobanks are just faster versions of slow monolithic banking experiences, but very generalized. Although I guess if you were to talk about maybe SoFi, they really specialized initially, but it was more like, hey, we can do that thing faster. We can refinance a student loan with you fast and digitally, and that was awesome for a minute. And then kind of the next wave of neobanks, you saw like Chime, we can get you your money 2 days faster and really target a community where 2 days faster is obviously a very, very important, and you saw the need, and they exploded as a result. Now what you're seeing is more like community and culture-driven neobanks.
Yeah, if I may just define a community, I think if you look at the traditional community banks, it's more regional, geographic bounded by geographic location. But now when you look at geographic or community in the neobanks, really expands across different communities, like geographic, so it's so boundless. So for example, there are neobanks that are starting to target underbanked or unbanked. So they go across multiple states, different regions within the country, but that's serving a community of certain segmentation. So I think as you said, I think it is expanding. It is a community, but it's a different type of community, I think, from the physical to now virtual community, which makes it very easier and also accessible for many people out there.
Yeah, I would agree. I think the only caveat that I would say with the specificity that they have is they have to make sure that the group you're going after is profitable, right? You have to make sure that there's enough of a market there that you can actually create, a sustainable, bank that's going to produce a profit at some point. And I think you also have to start with the profitability in mind, even though it may be growth at all costs at first. You have to say, okay, well, once we reach X, then we're going to switch to profitability, and we're going to, release these 6 products or whatever it is, and that's how we're going to make money. And so I think the only caveat to that, it's great to serve these different areas and have, a bank for golfers and a bank for, the unbanked and underbanked and all of these different things. But I think the qualifying and what we experience, especially when we're getting projections and financials from the bank side, to be a sponsor bank, is like, you think you're going to have 4 million accounts in year 2, and you're, how many golfers that want a bank account specific to golf are there, right? So I think there's some qualifiers that have to be put on that.
How much do Webster is an interesting example, which I guess is probably I just wonder, how involved do you ever get in refining the business models, or do you just kick it back at we don't have time to deal with this? Do you kick it back at that company or that startup and say, this is too aggressive, or or perhaps the market's too risky, or whatever, or do you just literally just kind of pass? Because I've definitely heard from banks that are either that are partner or that are these sponsor banks. They'll say the volume can be so high, the number of companies that are coming to them to do these, that it can be so high that it's almost like, we barely have enough time to tell them no. How does that work for you?
So
I'm sorry, I just turned into moderator. I apologize.
No, make my job easy, make me look good. I can just sit here. I love it.
So I would say there's a few different pieces to that, right? So there's the business model, and then there's the risk and compliance pieces. So there's really 2 different considerations there that we have to go through from a due diligence perspective. So the business model, obviously, it has to be legit, and we have to agree that you're going to make the money you say you're going to make, right? Because we have a vested interest in you being successful. The way Webster approaches it more from a partnership perspective, and we like to pick our partners, and so if there's a good idea but it needs some tweaks, then we're happy to kind of partner with you to kind of help you develop that in a way that I think we all can agree will be successful. Not to get into the weeds and not to say you got to totally change your product, but if, again, you're saying you're going to get 4 million accounts by year 2, right, we're going to work with you to say, okay, well, what's really the market? Where do you think this is what we've seen based on what we've done? The other area, the Grasshopper had a stat that came out that said that they declined 40% of those that come to them for fraud concerns. I would want to have context around that number. Is that just because of what you said, of saying, this is a gate and just no, yes, no, or is it something that they don't have a due diligence process in place to be able to kind of work with the fintech to say, you have a good foundation, but you need to tweak these things because you're going to see this, and this, right? So for Webster, I think we try to make it more of a partnership to make all of us successful. So both in the pricing models and also whenever you're considering regulatory compliance or fraud concerns, we try to kind of partner with the fintechs that we work with. But you're right. I mean, there's tons of them, that come up, and we have to kind of say, there's some qualifiers that it's like, these industries we can't do, and this we can't. That's really easy. But then there's others that we have to make, I would say, educated guesses on. Of, I think this one's going to be good, and maybe we don't go with that one. But it's a capacity issue.
But if at the same time, I think we built a number of neobanks, startups, digital banks. So the key thing is don't jump into technology right away, right? I think key point when you're building these solutions, you want to build for scale. Because if you start turning business down, you may be turning away very good customers, and you will never get them back. So the process we need to build, this is where we come in with a business consulting to make sure that we're building the processes and the KYC, the risk and compliance regulations, so we could actually scale up. Obviously, there'll be people false positives, as well as customers away because of the KYC concerns. But at the same time, there has to be a certain amount of scale that allow them to accept these new applicants and new acceptance, because now these days, the people just turn away from, if they can get a banking business, they turn away, they go somewhere else very quickly, right? So we have to there's a balance between the risk and compliance. This is where the neobanks do really well. They innovate, they come out with a new fintech capability to be able to handle that kind of volume and also reduce the risk. And then this is where neobanks really shine compared to existing banks, where they have processes that are really hard to change.
So digging into something you said there, you mentioned growth, you mentioned scale, and we've been talking about profitability. At which point does a neobank know, okay, I need to flip the switch from growth to scale to profitability? And then as the partner, and I'm going to lean on Chris for this part of the question, how do you think through looking at potential partners? Okay, this is someone who's in the growth phase, this is someone in the scale phase, and this is how we have to structure the partnership and act accordingly.
Yeah, I think that's a little bit of a loaded question, just because obviously we want everybody to be successful. But I think from a growth perspective, if you look at some of the banks that, I say banks loosely, obviously, that are in the market, like a Chime and a Current and others, there's some that have delayed their IPO, right? So if you're starting a neobank and, regardless of your reasons of starting it and what, customer base that you want to serve or whatever's going on, your two options is you go IPO and you continue to run the company and you continue to, and eventually reach profitability, or you are bought out, right? So those are it. So, at some point you're going to have to decide it's time for profitability. And I think when you grow to a certain size and grow at any cost, you have to say, again, it would be better if you started the neobank with an idea of saying, okay, we're going to do this, but then when we reach this point, we're going to be able to offer these products, and that's going to make us profitable. I think the one thing I would point out is in some neobanks cases where they have started with deposits and debit cards and stuff like that, the profitability typically comes from the lending products and credit facilities. And so for somebody that started in deposits to go to credit and lending is a way more complex beast than deposits. And so I think that is a harder jump, I would say, than say a SoFi you mentioned earlier that started in lending and then added deposits. You're starting with a profitable base and then you're moving and adding deposits as an added value. So I think the decision needs to come when you make the decision on what you want to do, because there's different ways that you present yourself to the market if you're looking to be bought versus if you're looking to do an IPO.
Yeah, I think I agree with you. I think the number of banks we are involved in now or in the past, most of them started with a lending products or mortgage products, and then acquiring deposit base later on to make sure they have a capital to be able to lend even more. So I think but most organizations that we work with, they don't go into thinking that we're just going to create scale and hope the profitability will come. They always have this business plan, maybe sometimes unrealistic, and we'll get in and we have a conversation with them and saying, this doesn't make sense from we do a lot of market analysis before we jump in with our clients. And we look at, the target market, target audience. We actually customize, build their capability around that target market, and we actually put some sanity check behind it. No, this market is not going to work. This deposit base will not work because the targeting people that you're targeting will not have a huge deposit base. You're better off targeting lending platforms.
Right.
So this is how I think the neobanks need to be a little bit nimble in that way, where traditional banks are more focused on rigid way, but I think this is where neobanks have a huge advantage in that flexibility and adaptability and kind of changing the course. I think that's something that I think is very, very useful.
You want me to answer that question?
If you want.
I think you just. I don't know. I'm kind of just. I think it was Mike Tyson with everyone. Everyone's got a plan until they get punched in the face. All of this all sounds really nice and elegant and easy, and then whenever you're actually trying to figure out. You scale first and then you become profitable. Like, fuck, it doesn't work that way. Sorry, I think I just dropped the first F-bomb today. It doesn't work that way, right? The way it works whenever you're actually running a business is it's messy and you're always making mistakes, right? And you try to make it look to the market, to your partners, to everybody that you're like that duck that's on the water, right? And your feet are underneath, they have no freaking clue how fast you're moving. And so I don't know that there's necessarily an answer here other than the reality of running a business is it's exceptionally challenging. There is no, there's right ways as far as ethics goes, but there's no real correct path. And so, making sure that you surround yourself with an incredible team and that extension is your bank partner is probably the only right answer. But anyway, it's kind of a cop out on a question, but the question is, in my mind, super challenging to answer from an operator standpoint.
So one of the, we've been doing a lot of discussion around the banks, the neobanks, but there is kind of a third piece of that puzzle, which is the BaaS provider. Is there an opportunity to eliminate the middleman? Is there an argument for building your BaaS in-house, or is it better to have more of a hodgepodge of multiple BaaS providers?
I think that's a great question for Chris and probably for Matthew as well, but I do want to just say one thing about this. And no offense to anybody, I feel like BaaS providers love to give this like elegant, there's a nasty world of banks down here, and then there's this thing that you want to do, and then there's this wonderful like world of connections between the BaaS provider and the ugly world of banks, and it's so elegant. And I can't tell you how many neobank and just fintech in general companies and CEOs that I've talked to who are like, man, I got sold a load of bull from my BaaS provider. It is not as elegant as perhaps the sales process, made it out to be. And not to say that there's not great BaaS providers out there, but at the same time, I'll say that there's definitely a lot of noise in the system. And so, I could probably count on one hand the number of organizations I know who are happy with their BaaS provider. Much like I could probably count on one hand the number of banks out there who are happy with their core provider.
I think if you look at the market, I think the bank as a service model works really well in a small community and regional banks, smaller regional banks where they may not have the reach that they're looking for, but they need to compete with the much larger banks who are starting to gobble up other banks. So how do you retain your base and how do you continue to grow? So partnering with this service firms that allows them to get access to people that you never had access to before, ability to provide faster lending. So origination, right? For example, lending, origination takes a lot of effort and manual labor. But if you could actually offload that capability and you're just looking at the risk part of it only, you could speed up the process as well as now you're reaching into customer base you never had access before, where you would have to just focus on the existing neighborhood basically. How do you reach out? So I think there's a best of both scenarios, but what we're seeing now is that the neobanks are starting to merge with banks more and more because OCC is taking forever to approve them as a bank, right? They are given an opportunity to start up the bank, but approval of a bank license is just a nightmare these days. I know for a bank that they told them it's going to take 2 to 3 years to get the license, so they're forced to deal in that concept, that model. But it's working out in many different community banks who are struggling to get by, and now because of this new capabilities, now they're able to reach out to new customers, and bottom line is they're not increasing their operational costs, but they're able to handle more businesses in general.
Yep. You're up, Chris. Defend yourself.
So what I would say is I don't know that there's going to be a case to get rid of the intermediaries completely, right? So each of these have, to your point, they provide a service to the smaller institutions that don't have the infrastructure or resources to be able to do it on their own, right? So if one of these providers comes to a sub $10 billion bank and says, it will integrate to your core, we have all of the infrastructure to do reconciliation and all the APIs and connect to the fintechs, we'll bring the fintechs to you, that's pretty appetizing, right? So I think there will always be that. What I say would happen is that typically what happens is you have two financial models that are prevalent in BaaS. You have the financial construct and then you have the SaaS construct or software as a service kind of pricing models. And so typically what most of that I've seen for these intermediaries is they do both. They have the financial model where they charge a portion of interchange and fees for wire, ACH, et cetera. And then they also have SaaS charges for webhooks and different APIs that you call, and you have thresholds per month, and then you pay 1 to 2 cents or whatever it is after that. Our approach at Webster specifically is that we side on the side of the financial model more. So a portion of FedPos, a portion of interchange, fees for ACH and wire, and we don't do the SaaS model. And the reason we structure it that way is because if I can charge maybe a little bit more than one of these other providers in, a portion of interchange in other areas, even though I'm over 10 billion and maybe, debit interchange is not my sweet spot, I can still provide the same or close to the same services and level of service that these other providers are giving you, but it's gonna be cheaper in the long run because you have an overall pricing model based on the financial construct versus SaaS model, or both together. And so that's kind of what we've been looking at and trying to position ourselves, not only in the partnership perspective as partnering with the different fintechs and neobanks, but also trying to look at what's going to make everyone successful. Because if we price you to death, that's not going to be good for anyone, right? And when you put an intermediary in there and another person or another entity in between, the margins on some of these things for interchange and other things are thin already. And so when you put more players in between, it just makes it even thinner. And then, the economics for the fintech just doesn't work.
But you nailed the pricing part of the question, but there's the other side of the question, which is your overall platform, and the extensibility of it, and the odds of a neobank sort of running into a wall and saying, "Oh, you don't support X? Great, now I've just got to go find another partner to go do this other thing," And how do you address that on the way in with your neobank partners? Because I feel like that's the complaint I hear more often than not on the neobank side. It's not that my bank has run out of balance sheet necessarily. It's that, or even on the interchange side, that they're not sharing enough interchange. It's more the BaaS partner isn't as perhaps modular, or the platform isn't as big as maybe what was sold up front.
Yeah, for us, we're getting there. I can't sit up here and say that we're ready and that we have APIs for everything, because we don't. But that's the target state, right? That's where we want to get to, and I think we have a better way to approach it than some of the other players just because of those reasons that I said and the partnerships. Because we can work based on experience that we've seen and see what you need and what you want. Because essentially, I mean, if you really look at it at a foundational level, these fintechs want exactly what the digital bank wants. You know, they want the webhooks, they want the real-time data, they want all of these things. They essentially want the same things. And so if we build the infrastructure how we would build the next-gen platform, then that by and large is going to serve them. But we have to talk to the fintechs in the space. We have to get customer feedback. You know, we have to understand where the market is going and be able to, you know, develop something before it gets here. That way we have it ready to go. You know, I mean, the emerging payments is one major area. And then, you know, just the API infrastructure generally is another area. I think one of the hard things about having a global product in that aspect is that you have this balance of one person's asking for it, but you have to invest in creating it. And is it worth it and what's the ROI? So we'll have to balance that as we go through that.
So we have just a few minutes left, and I wanted to do just a rapid fire round of quick questions, present company excluded from your answers for the relevant questions. So starting out, what is your number one prediction for the neobank space in the next 3 to 5 years? Chris, do you want to kick us off?
Oh, geez. I think there will probably be some consolidation. I think you know, we see the funding models decreasing, fintech funding decreasing. I think the valuations that some of these companies are seeing, because they're typically valued as tech companies rather than financial services companies. I think you see a JP Morgan Chase and others that are out there and they're wanting and kind of presenting themselves as a tech company, and they want to be valuated as such. Because they see these big valuations. I think that is starting to shift. You're seeing more and more where the valuations are a little more reasonable, I would say. And then I think you'll have some of the neobanks that have to choose, to our question earlier, do I switch to profitability now? And how do I do that? And I think there will be partnerships that will be announced, I would think, in order to create those, because I don't know that all of the ones, even the large ones that are out there and successful ones that are out there now, have the capabilities in-house to be able to offer, you know, especially when you're talking about credit lending and things like that. I think they'll need to partner with others to be able to do that.
I would say that I agree with Chris, but also depends. The answer is it depends. Because we look at our
The consultant says it depends.
we look at the neobanks in kind of globally, because we have operations in the Americas and Europe and Asia. So we're looking at the markets. Asia's now ramped. They're looking at the licenses. There were over 250 the neobank licenses globally, and they're led by Asia as one of the biggest startup, and as well. And then there's Europe, and then there's Americas. There will be consolidation because you could slice and dice so many different ways. Eventually, you're going to run out of bandwidth, as you talked about, making money at the end of the day. So there'll be consolidation, but also the technology changing the landscape. For example, now the banks are starting to look at open banking concept to bring in fintechs much faster into their overall product and services to compete with the neobanks much faster. So there will be consolidation. But Asia is ramping up. Now we are seeing tremendous activities in Asia. Europe is just going gangbusters over there, and Americas is somewhat slowing down. But we see it as a consolidation, definitely, and also profitability will be coming back to profitability as they're looking at the market conditions starting to get slower and slower. Now investors will be looking at more profitability. Are you in the space to make money or to increase the value of the company? Because now the valuation is starting to flatten out. So I think you're going to see that consolidation also focus on profitability as well.
Valuation flattening. I don't necessarily. What I see probably as a little change to that is just the story behind your data and the worth of your data suddenly is increased dramatically. So being able to show the value of the customer and what they're actually doing, as opposed to maybe selling a story of what you might do one day, that's probably where the change is. The money's still there, I think. from an investment standpoint, presuming that you've got real data to back up the story. But to me, I think we're going to see a lot more embedded approaches, just all across the globe, not just here in the U.S., of course, but we're going to, that it's just it's a natural. You saw, I think Scarlett Seaver just released her book, Embedded Finance, or whatever it was, a couple days ago. And it's certainly been, on the tip of everybody's tongues the last few years, but I think we're going to see a lot more of various embedded approaches with very large sort of enterprise companies.
And so is there one neobank that you're particularly excited to see what they're doing in the next, or how they're doing in the next 5 years? Nerve
Can't wait to see
be
Nerve.
mentioned.
I was about to say.
No, I mean, outside, you said President Covenant excluded. I respect, there's a number there's not one in particular, no.
I think what I'm seeing is that I think larger banks are learning from neobanks. I think eventually they'll, they are slow to act, but eventually they'll get there.
One day.
One day, but I think they are, revamping. They're spending tremendous amount of money, and they have the funding behind it to really make the change to be flexible and nimble. So I think there will be some battlegrounds in the middle, but I'm excited to see that now the banks are starting to think about consumers versus profitability, which is very exciting to see from our perspective.
Yeah. I like Current. I like what they're doing. I like their business model and what they've structured. The 4% APY and then in return is interesting, and I think that gives them a lot of customer base and potentially profitable customer base. So I'm interested to see what they do with that in the future, especially as DeFi and all of these things start to settle down and not be as volatile as we've seen in the past couple months.
Makes sense. And with that, we are at time. Thank you guys for joining us. Thank you to everyone who sat in on this session. We really appreciate it. Yeah. Do you guys have any final thoughts? Follow me on these social medias, see what my company's doing that you want to share with the group?
Nerve.pro.
And yourself?
LinkedIn, Twitter, and obviously websterbank.com. So come check us out.
Yeah, hopefully most of you know Cognizant. We are a global IT consulting organization, and we serve much larger, large global banks to a community bank. So we look forward to some exciting opportunities within these banks to see some new capabilities, and pretty excited about it.
Awesome.
Thank you.
Thank you.
Guys.